Today, more from the property market frontline. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. Today, I'm joined by Chris Bates. Hello, Chris. Good to see you again.
Good to see you, Martin.
Now, Chris, you are in an interesting position as a financial advisor and a mortgage broker, so you're right in the middle of all of the noise and pain that's out there in the industry at the moment.
Yeah, and I mean, all my clients are young families as well. So, you know, it's and their biggest challenge is property. So it's understanding whether, you know, to buy, not to buy, you know, to renovate, to buy an investment property, etc. For younger people, it's really front of mind. Whereas, you know, a lot of financial advisors work with a lot of older clients, you know, 50s, 60s, 70s, 80s. And a lot of them more worried about their super and, you know, paying down their debt and things like that.
So we spoke about 3 or 4 months ago, and
Yep.
we were sort of both agreeing that things were probably a little bit on the slide.
Yeah.
It's probably fair to say that the slide has been a bit more dramatic and quicker than perhaps we might have expected.
I think so. Like the last month, I think it's a lot of the negative news, and I think some of the figures are coming through, and there's always a bit of a lag, right? So I think it's starting to get a bit more worrying for people. I think when Sydney was down like say 7%, people were like, oh, don't worry, it's just a 7% fall, but now that's like 9 or 10 or 11, and so I think, and it's now the longest fall, you know, even bigger than the 90s, I think. So, you know, I think people are starting to think, actually, this is not just a normal correction. This is actually quite serious, and we're not sure where it's going to end. And a lot of the big media outlets obviously are coming out and changing their views, you know, the AMPs, the NABs, etc. And, you know, they're becoming even more pessimistic.
And I think last time we spoke, we made the point that not all the micro markets are the same, right? So there are areas in Sydney where effectively there have been quite significant falls, but there are other areas where, in fact, perhaps prices have not really moved. Are you still seeing that variation, or are the trends now more sort of down across the board?
Yeah, I think whenever you think about the property market, which is dangerous in its first place, then you've got, you know, states, and then you've got capital cities, and then you've got, you know, within those capital cities, you've got houses and units. And I think that's people have to keep going deeper and deeper markets within markets to understand the market. I guess the big thing when you do that, though, is you can easily split it and go, who is buying this property to live in it? You know, they're buying it because they want to raise a family, or they've got kids, or they're downsizing, or, you know, they work in the city and they want to live close by. If they're buying it to live in it, that's one type of property. And people want similar things. Generally, they want houses, they want a bit of backyard space, they want it near a train station, they want it near good schools, and, you know, on quiet streets. So those type of properties are in high demand at all times because there's only so many of them. But the other side of the market is the investor market. And that market, however, you know, really is mainly bought units because of low maintenance. You know, they thought it was cheaper, lower price point and things like that. So you always got to kind of cut the market into two, I guess. I think on the home, the investor market, firstly, I think that got smashed because of, you know, the APRA changes to lending. And they said, look, you can't borrow in like 10 times salary anymore. You can only borrow 6 times salary. And so it basically just, you know, stopped the investor market full, you know, on its knees. So, you know, that market's just going to keep on cooling off, because unless investor market's like a switch, it either invests or it doesn't. And, you know, when interest rates dropped, it just went on overdrive. But when interest rates are, well, they're still going up a little bit for them, but because of the credit, they're kind of pulling back now. So the home buyer market, though, is just kind of like this ongoing kind of demand increase, because as people get to their 20s and their 30s and population increase, you know, over time we keep building up a bigger and bigger demand. And so that's kind of supporting it a bit. But the home buyer market, I guess, is really struggling with borrowing capacity. And so this is not a bit of a new problem, because before banks would always give them more than they needed, but now they need to pay more than they need for the property because, you know, prices have maybe doubled, but they can borrow a lot less. So it's this real kind of challenge for them.
Yeah, well, let's take each of those and maybe explore them a little bit further. So firstly, the people who are trying to get a loan in a property to live in, right? I mean, my research suggests about 40% of them now are finding that they're getting turned down. Their applications are being turned down, whereas it was a year ago, it's 5%. Right?
Yeah.
For exactly the reasons that you said, and that's because now they have to have a lot more evidence, firstly.
Yeah.
And second, the multiples under which they can borrow are significantly different. So how's that playing out in practice? I mean, are people being asked to, you know, pony up more statements, or how does it work?
Yeah, no, it's really interesting. I reckon it was probably June time where like it was just complete different mindset shift with assessors. So assessors would go from, look, we really want to work with you. I want to work with this customer. Let's make this work. To, well, no, we want to decline the loan. Send us more evidence. And they really went to slow down the application process really. And so before you really, there's pretty standard questions you had to prove. Prove who you are, driver's license, passport, prove what you earn, a couple of pay slips, maybe a tax return, a PAYG, prove what you own. So maybe like a rates notice and some share statements. Like those are all pretty standard. Prove what you owe. So like home loan statement. Sometimes they wouldn't want to see your credit cards and your car leases. It depends on the bank. But the last thing is that prove what you spend. You never had to provide that. It was always a customer declaration on what they said, you were spending. And unfortunately, that declaration a lot of the time was under the minimum and the banks would just use the minimum. But now that's just not going to fly. And, if a loan is lodged under a minimum, pretty much every bank will ask a lot of questions and, it will go through a lengthy process. If you lodge it and it's above the minimum, it really depends on what bank at the moment. Some banks are going into a lot of detail, wanting 3 months transaction statements, literally everything you're spending, and then they're cross-referencing it and saying, look, you said it's a minimum. You said $5,000. We can see you're spending $8,000. Obviously this isn't working, and they'll use the $8,000 unless you can say, $3,000 of that was a one-off cost to fix the roof or something. And so that's kind of how it's playing out around the expenses. It's a bit of a changing process. There are some banks that every application you need 3 months bank statements, and I do feel that from probably the Royal Commission time next year, I think every bank will need your last 3 months transactions, because I don't think these banks are doing it because they want to be good guys. I think they're doing it because they know it's inevitable anyway.
Right. So that requires a lot more evidence, a lot more organisation from potential borrowers, right? You can't just rock up with a pulse and get a mortgage. You've actually got to do some work and be able to produce the evidence. And the banks are taking a much more conservative view then of what that means in terms of the amount of money you can get at the end of the day as well.
Yeah, definitely. I mean, going and just, clients sometimes buy without a pre-approval in the past, right? And, that was quite easy to do because if you had a really good job and you had the savings, you knew a bank would lend you the money. And so a lot of buyers would just say, I want to buy, I'll do the pre-approval, it's okay. And then, they would not even really go and get a pre-approval. It's pretty crazy. So people aren't really even prepared enough just to go get a pre-approval. But now you've got to be kind of prepared like 3 or 6 months before. And if you're spending a lot of money, you've got to cut back. And then so you've got to change your lifestyle. And, the way that minimum living expenses have been in the past, it was obviously much lower than what most people were spending. So it's going to be really testing time. I think just banks more generally, before it was always just, if you fit policy, we'll give you the loan, And so, you knew that the loan would get approved. Now banks are looking at the file and saying, look, is this really a customer that we want? Are we going to make money off them? Are they, got right type of mindset towards debt? Have they got good property? And they're actually declining loans for not just reasons like it doesn't fit policy, is that they just don't want you as a customer, which is crazy, from where it's been. So I think, going forward, if you were looking to get a loan, I think all clients now are closing down every single credit card. Any HEX debt. I was just on the phone with a client there. He's got an $8,000 HEX debt. Just get rid of it. Don't consider any of these kind of short-term like Afterpay and Zip Money and all these. The banks will hate those because they're, at the end of the day, they're competitors to them. And they just want really clean applications and all the documents laid out. And from a broking point of view, we're having to do like almost a full-page cover letter, talking through all the risks of why the bank might not like them as a customer, and lodging it because, as soon as we get in this back and forth, a bank's more likely to decline the loan.
Right. And does that mean that the loan process is taking more time and effort than previously as well?
It's interesting. I think from June till maybe October, November, it did, because I think the banks were just scared, not sure what to do. The whole risk of lending the money and getting, coming back in the future and saying you lent that money irresponsibly. And I think all the banks had big loan books, the big four mainly, and just said, look, let's just hold off fire. Let's not approve any more loans. I think in the last 2 months, I think there's been a bit of a mentality shift. I think at the end of the day, the banks have got shareholders. The shareholders want to, see the loan book growing. They're losing a lot of their business to the kind of the INGs, Macquarie's, the international banks, and the non-banks. And I think they're just starting to say, look, let's get these loans through. If they are a good customer, let's get it through credit, and let's not just lose a good customer. If there's any problems with the application though, and they're not really sure, then it's getting stuck. Fortunately, we're getting almost faster pre-approvals or past formal approvals now than we were say 2 years ago, because they had so much work. But now they've got no work, and then if it's a good customer, they're just trying to get it through.
Okay, right. So they're picky,
yeah,
but good customers can still get the credit, and the processing time is not particularly extended.
No, it's actually really fast.
Okay.
So, but you have to kind of, and I think that's a lot's come down to the way that we're lodging loans now as well, because we're going through, before if there was a document missing or, there was something on the pay slip that hadn't been clarified or something, we could just lodge it and then speak to the assessor, and then the assessor would go, that's fine, I'll just make a note. Now that you've got to make sure you do that all up front.
Okay.
You've got to be, end of the day, if you do get a decline on your file, that's not going to look good. You're going to go to another bank, you've got to justify it, it comes up on the credit. So before you lodge a loan, you've got to make sure, all your ducks are lined up.
And you mentioned the non-banks, who seem to be growing quite a lot faster than the banks now. So are you seeing more applications going off to the non-banks?
Not personally. I'm just not a fan of it. I just don't trust the non-banks in terms of, if things do, go bad and, them as a bank, as a non-bank, but they struggle financially, what's to say they don't lift interest rates? And if you have to use a non-bank because you can't get a loan with one of the banks or even one of the international banks or etc., that's probably because of servicing. You haven't really got the servicing at other banks. And so you've got all this debt and you've gone there and then they lift your rates on you. How can you refinance that loan? And so I personally don't do any business with the non-banks, because if you're stretching your servicing that much, there's probably a problem there. Maybe you're over leveraging. And if you have to refinance for any reason because their rates go up or something changes, you just get stuck. And so, I guess you've talked a lot about mortgage prisoners. I think that's definitely not where you want to be a prisoner of, rather than a big four, where most likely if you negotiate a good discount at the big four, they're always going to compete with each other. So you're unlikely to get that kind of big rate rise. It's unlikely that Westpac are going to go up 2% more than CBA or ANZ, etc.
Right. Okay. So basically what you're saying is the non-bank sector, by definition, don't necessarily play by the same rules.
Yeah.
And there's probably more risk attached to what they may do down the track compared with the main sort of four banks as the way that they compete with each other.
Yeah, and as you're signing a 30-year loan contract, right, with a bank, a non-bank, and, unless you can refinance that loan in the future, and you just don't, I guess with any property investment, it's all about risk management and saying, if I'm doing that, as long as it's, I want to make sure I can hold that asset for the long term. And if there is a downturn in the cycle or there's negative equity or, I've got higher interest rates, I can ride that wave out. And I'd much rather ride that wave out at a big four or a second tier or an international bank that are competing together than a non-bank.
Okay. Well, let's now switch across to the investment sector. And you said, people are voting with their feet, and effectively the investment sector has really drifted a lot lower recently. What about people who've got investment properties already? How are they coping with the current environment?
If they've had good investment properties and they've seen lots of capital appreciation, they've held them for a long time, they understand they're in a good location, maybe they're houses as well in these inner rings, and they're good assets, there's a lot of built up goodwill in their mindset, and they're not seeing lots of apartments getting built around them, and they know they've got a good asset, they're more likely to ride out a cycle. But if you bought something and, let's say you bought a new unit in Melbourne or Brisbane or in Sydney even, and you've seen a lot of kind of a little bit of price, inflation or rise, or maybe sometimes not, and there's a bit of a, more apartments are coming up, there's more negative news, especially in the off the plan sector, a lot of, what I was talking about, say 5 years ago, risky, supply risk, investor risk, that's on the front page of the Daily Telegraph now, and every paper. So I think people who have got assets that they're now starting to switch on and go, actually, all property doesn't go up. Some are more risky than others. And I've just got $2 million of debt and they're 3 poor properties. What do I do? And so a lot of them are going, look, should I sell? And, and it's, a good idea for a lot of people, because, if it's a poor asset, unless it's a poor asset because of two reasons. One, there's a problem with demand because it's not the right type of demand. It's probably investors that want it. It's probably, or if it's homeowners, it's really low income homeowners or singles rather than double income, high income families that really want to live in it for a property. Or it's a supply issue. They're just building more of them. And so if your property's got both of those, you can see why a lot of investors are going, wow, this isn't going to get any better.
And we know that the rental streams are not really growing very fast. In fact, in some cases, we're seeing rentals sliding. I was talking to somebody in Perth the other week, and they've got a 20% cut in their rental streams compared with 2 or 3 years ago.
Yeah, I think the vacancy rate in Perth was 9% or something crazy, and it's gone down to 6%. But that doesn't mean that every property's gone down to 6% or every suburb's gone down to 6%. And, there's very tight vacancy rates in parts of Sydney. But if you go to some parts, like, let's say, Ryde or the Balcombe Hills and things like that, vacancy rates are rising quite quickly. And, even if your apartment's brand new and it's shiny, that doesn't mean you're going to get a premium rent for that. If there's 20 apartments for rent at the same time, the renter's just going to, negotiate really hard with you. And you can definitely see that in areas where there's lots of apartments, rents are actually going backwards because people are getting desperate because there's 600 properties for rent in, say, Rosebery, and that's just one suburb of apartments. If you go Waterloo, Alexandria, the problem just compounds. And
it's interesting because those areas that you've discussed are areas where, in fact, unit prices have dropped quite considerably over the last few months, and more than 20% in some cases.
Wow, okay. Yeah.
So it's a combination of greater supply, more new builds coming on stream, the fact that they're harder to rent, and therefore the rental equation doesn't look as good as it used to.
Yeah, and you can't sell it because it's a commoditized product. And so you go to a real estate agent and say, I want to sell this 2-bedroom unit in this high rise. How do they sell that property and can say that it's better than that one and that one, and there's hundreds for sale, and the only ones that sell, if I was a buyer in that market, I've got so much choice, I'm just going to do low ball offers. And then the pressure is because there's no buyers, if you have to sell because of death or divorce, or you can't afford the mortgage, or you lose your job or something like that, you've got to take this low ball offer. And I think that's why we're going to start seeing these. That doesn't surprise me at all.
So that's really going to be a question. You said they may have to sell, right? And it sounds as though you might have to sell and be prepared to take a really low offer to get out, because the longer you hold it, the worse it's going to get in terms of price falls.
Yeah, I think there's, end of the day, if it's a poor asset, you need that to... Poor assets kind of go up with the market, all ships rise in a rising market, Some don't rise as much as others, and that's why a lot of people, they look at their property and go, oh, it's done really well for me. It's gone from 300 to 500. Well, in comparison to what, And if you compare that to other properties and other investments you could have made, and etc., then you can tell whether it's actually been a good investment or not. And so when the market's rising, everyone just thinks that every property is a good investment, because they can just see a number, artificial gain. I think in the fall, that's where people are starting to realize and go, well, actually things could actually keep going. And, how long do I have to hold this property for? If it's a good asset and it's in the housing market and it's in a good location and it suits families, you really probably wouldn't want to sell that asset now, because all you're going to get is low ball offers. And so you would, if you could, ride the wave for 5 or 10 years time, to more, population growth, there's already limited supply, wait for that kind of period if you can. But if it's a poor asset, like, what are you waiting for when investors go on overdrive again? And when's that? If things like, there is a call for negative gearing to go, and it was at the last election, it has been in the past, it's likely that some type of change is going to happen there, whether it completely goes, whether there's a cap, whether there's a limit on properties, some change is going to happen, and that's not going to be good for the investor market. So, I think people are realizing that. I mean, it's gone from FOMO to FONGO, which I think, your listeners will probably know about.
Absolutely. Fear of not getting out.
Yes.
And I see a lot of that in my surveys, right? So effectively, a lot of people saying, the economics no longer work for me. Right? So either I've got to sit there and basically take pain for a good number of years, or I try and dig my way out now, which is why quite a lot of people are putting property on the market now.
Yeah, I think there's the opportunity cost. People realise and go, well, not only I'm in $2 million of debt, or 1.5, or whatever it is, or $1 million. What am I getting for that? And I've got an asset. I'm taking a lot of risk, and I'm losing money every month. And if I'm not getting the rewards from it, this is all too much hassle and too much. I'm getting not sleeping at night. Let's just get rid of it. And so I think that's what's going to keep on playing out. That the people who have got properties that are investors now are just going to say, look, let's just this is too much risk for us. We're not comfortable, especially when you add in the principal and interest change with interest only. A lot of people didn't really understand interest only. They thought that in the end of the 5 years they could just easily roll it over because that's what it was always like. But now they're kind of coming up, or they've coming off the interest only, and they're seeing their repayment jump 40-60%, and they're going, I can't afford this, and so they're more likely to sell then, aren't they?
Absolutely, yeah. Well, a whole bunch of imperatives begin to come in over the top. And I guess that takes to another interesting area, which is we're seeing property values continuing to slide. And, I think our expectation is more slide next year. But that means some people are going to get into that rather uncomfortable position of negative equity. In other words, the loan is actually worth more than the value of the property.
Yeah.
Now, what's the story there? Because that seems to me to be a very, very nightmarish situation.
It's not a new story, I guess. It's happened all over the world. I was in the UK, you were too when it happened, and it's Ireland and Spain and, all the countries, and the US obviously, but you can throw your keys back there. But, you can't run away from the debt here. And so you can't just walk away and say, look, that's your problem. The bank, you shouldn't have lent me the money. And so I think it's happened in areas like mining towns massively. People have, risked their home on gambling on, lots of different Port Hedland and, all these sort of places. So it's just that now it's hitting the capital cities, and it's now hitting our two premier capital cities. It's a lot in Perth as well. A lot of people in Perth have had negative equity. So I guess the story is now coming quite mainstream because it's hitting, families in our capital cities. The big problem is the people it's going to hurt the most is first home buyers, and it's first home buyers that have bought in the last 4 years. And so they're bought in the boom. They didn't really know what they were doing. They maybe have borrowed, saved up 100 grand, worked really hard in their 20s, got these 100 grand, paid for their wedding or whatever it is, and then finally gone, right, let's go buy a property. Bought a house on a land package, or thought we're not ready for a house yet, let's buy an apartment. And so they've gone in, they've probably borrowed 90%, or 88%, or even sometimes 95%. They may have borrowed some money from their parents, and they've gone and put it all into one property, and that property has now fallen, let's call it 15%. That could be a $50,000 loss. So they've lost everything they've had. And unfortunately, the state government kind of encouraged it, like no stamp duty exemptions, buy new. And they're the properties that are going to get hurt the most. And so I really do feel for people that, were just doing what their parents and society told them to do, and their friends and their work colleagues, and you've got to get on the ladder. They've gone and risked it all just not knowing what they're doing, because property always goes up, and now they've lost everything. The problem is that if they've got a house that they can grow into as a couple and as a family, and it's really where they want to live long term, then they're going to be okay. Yes, they may not get the capital appreciation, and maybe they're not going to walk away with a lot of money, and they've got a place to live, and that gives them a lot of satisfaction from life, because property has got a huge element of it's actually a tangible benefit for living somewhere rather than renting.
Yep.
And the benefits of security with kids and schools and things like that. So if they're in that position, they've got a house they like, they're going to be able to grow into it, enough bedrooms, and it's in a location that they really want to stay, and they're probably just going to ride it out and just make the mortgage work harder at work, and stay. But if they're in an apartment, because that's what or they're in an area that they really don't want to live long term, or the house is just a small house, what do? They're stuck in a house that they don't really want to live in. So they either stay there, or they turn it to an investment property and just rent it out. But then they've got no money for going and buying something else. Yep. And so they're basically forced to rent until they build up enough deposit again to buy something else. And that could take 5-10 years. So you're kind of stuck, because you can't just sell the property, because then the bank will say, well, you're selling the property for $1 million, your loan's 1.1. You owe us $100,000.
Yep.
And so the bank will, the only option there is to go bankrupt, and that's not a great option. So it's going to be tough.
And in that situation where you're living in the property, you've got a paper loss, would you encourage people to try and pay off more of the loan to sort of take the loan value down, or just put up with it.
Yeah, I mean, it's paying down your loans, good advice
Right.
at any point of life. If you pay it off on the bank's term, which is like 30 years, you're going to pay a lot of interest. It's great for them. It's not really good for you. End of the day, if you've got a good asset and it's growing tax-free for you, if it's a good asset and you're paying down the debt, it's kind of a really good way of kind of protecting yourself and de-risking your future, really, just building more and more equity. If you're in a position where your house price has fallen and your debt's really high, yeah, I'd be trying to get out of that negative as quick as you can,
right.
And not just kind of assuming prices are going to go back up, because what happened in Sydney or 2003, 2010, market was flat, let's call it, and we could see that as well. So you can't wait for the market just to come back, especially if it's a poor asset and, there's more supply coming and there could be fire sales and, that could affect your valuation. And so I'd definitely be trying to get out of the asset. And sometimes it's taking a loss is not the end of the world. If that loss allows you to, if you can afford it, maybe it means you've got more home debt, if it's on the investment property, if that stops you losing more money or gives you an opportunity to buy a better asset or to, have less stress or whatever it is, sometimes people, we've got this loss aversion, it's a natural behavioral bias. Yeah. We wouldn't want to take a $30,000 loss on a property, but that could be much better than losing the next 20 years and losing 100,000. So, I think we need to sometimes just take our loss and run.
I think that's good advice, because often people sort of think, oh, shit, that's a negative number, I don't want it. But in some cases, it is probably the best strategy to be able to actually deal with it. Either that or pay down a bit faster to try and get the value of the loan down a little. If
you pay down the loan, you're actually saving. And so that money is an actual opportunity cost. You could be paying off your home loan if it wasn't your home. You could be investing that money. You could be putting it into super. Just paying down the loan sounds great, like you're going to get out of it, but that money could have been used for something else. Right. And so a lot of the time it's you're just basically paying off a poor asset. And so generally it's rather than paying it off, you're kind of probably better off to get rid of it and pay off either a better asset or invest the money.
Okay. Interesting. So quite complicated sort of calculations that people need to do then. It's not necessarily straightforward.
Yeah, and I don't think it's no, everyone talks about the good stories at a barbecue. I bought a house for 500, I spent 200, I sold it for $1 million, and I've done that 4 times or whatever. But no one's going to sit there at a barbecue and say, look, I actually bought an off the plan property. And it lost me $200,000. So those stories, and that's the problem with property, is that people don't talk about the bad stories. It's always about the good and markets going up. And I think a lot of people would get comfortable learning from others and making decisions on these things, but they don't know where to go. Who's actually going to tell them to whether to sell or to. It's very difficult.
Yeah, well, one of the reasons why we're talking to you, Chris, because you know about this stuff. That's why this is a really important conversation.
Yeah.
So, look, here we are, the end of December 2018, right? 2019 just around the corner. What's your best sense of how 2019 is going to play out in terms of property?
It's going to be a really interesting year. I mean, I'm not an advisor that likes to, in any part, like in the financial planning side with shares or anything like that, to be forecasting or pretending where I know where the world's going. I guess what all I can see is there's lots of headwinds. And, unless those things, like markets, especially the property market, it's driven by confidence, right? You're not going to go to the bank and put yourself in $1 million of debt unless you feel really financially secure, really confident about the asset. And, because it's such an emotional thing anyway, and you're leveraging a lot of money, it takes a lot for the market to get going, and that's when it does, and then it kind of snowballs and it takes off. And so, it's looking likely that the Royal Commission's a huge thing. We all with these big things we get like fatigue, because you read it every day, and then at some point you're like, I'm just over this, but nothing's happened yet. No recommendations have come out, and so until February, until that comes out, everything's kind of on hold a little bit. And if that comes out like everyone thinks it will, that's going to have to change the way banks look at lending. And, that means that the way the market is priced has to change with the new rules, not with how it's used to, because property is priced today, and that's will be priced on what people can borrow at that point in time. And so I think that's a huge thing. The election, it's pretty crazy. If Labor get in, they go ahead and their policy comes through, without doubt, I personally believe that, parts of the market would get severely impacted, like, the unit market and where investors buy, because new investors won't buy in those areas, because they can't get negative gearing. So that could have a huge impact. The interest only thing's really interesting. So, we're talking today and, the APRA change with, the cap. I don't think it's a great that APRA is doing that, but will it have a big impact? I don't think so, because I think the investor market is already, not investing. They don't really care whether they can get interest only or not. They're just not investing. And so saying you can get interest only again, I think they've already killed the confidence of investors by saying, look, you may not get interest only. And that's a different mindset to the past. I think we're going to see a lot of settlement risk next year. All the off the plans that were bought mainly in Sydney in 2016, 15, 17, these are all going to complete in your areas where there's all those cranes that are getting built.
Yep.
Those are new apartments, and the valuations on those without doubt are going to have to come in quite low, because there's going to be sales in the area that the valuer has to use. And no matter how much the developer wants you to think that it's worth $1 million, the valuer is the one who determines the price. And if they think it's only worth 800, and then the bank will only lend you 80% on that. And the big problem with this is you can't walk away from your deposit legally. And a lot of people think you can. You put your 10% deposit in. If it doesn't work out, you just walk away. Well, not really. And the developer in the past has said that's fine, because they could always on-sell the property easily in the market for a profit. So they said, look, if you can't settle, that's fine. I'll keep it. I'll keep your 10%, and then I'll resell it and make some money. Now the developer's going to say, well, I'll keep your 10%. I have to sell it at a loss, and I'm going to come at you for the loss. And so that's going to be a huge problem in 2019. I think the what you're going to see, though, we have seen a repricing in the premium suburbs of your capital cities, in the inner ring, in houses. And that's because of lowered borrowing capacity. All the buyers that were shopping in the 1.5 are now shopping at 1.2. And all the, the twos are now shopping at 1.6. And so it's really pushed all the buyers down, and that's pushed prices down. But it's also sucked buyers from the other end. The people that were buying in, say, this suburb for $1 million, well, now $1 million buys you here. And so all the buyers out, in the western suburbs generally are coming closer to the city, because they can get more for their money or closer to the city. And so what it's doing is creating this kind of, congregant of buys kind of really close to the city at a reasonable price point. And I think there'll be a price point where in housing in these areas where investors will say, wow, I can get a house in Balmain for 1.1. That was 1.5. And so there'll be a lot of people who go, well, I've got the confidence to invest in these markets as well. So in the good suburbs, in the good areas of the capital cities, at some point there'll be a floor. Like there was in London and New York and the GFC. There's always people who are looking to take advantage of down markets, and they'll want to buy the quality assets.
But the implication there is that perhaps those areas further out that are perhaps less good, if I can put it in core quality of life terms, they're the ones where we're going to probably see more pain as we go through 2019.
Yeah, like if you added up all the houses in, say, the 5 kilometre ring, and then you added up all the houses in the 5 to 10 kilometre ring, there'd be a lot more in the 5 to 10 kilometre ring, because it'd be 5 or 10, right around the onion. And then if you keep on doing that, what you find out is there's more and more supply the further you go out. And so there's more and more houses, and there's not this pent up long-term growth that people have seen. There's been a real short-term growth in a lot of these suburbs where they've benefited of this low interest rates, cheap credit, easy access to credit, fear of missing out on the market. And so, even though then, in my view, they're not great assets because of the supply risk, they've gone up a lot in value. And so, I think that they're the properties where, you're going to start seeing falls, and people are going to say, I want to bank those profits. I want to get out now. And there's not that kind of confidence just to ride it through. And I think that there's the ones, you're going to get a lot more listings. There's going to be no buyers, and then you're going to start to see some fire sales where people have to sell, and then it recreates a new benchmark for prices. And so I do worry about the outer suburbs, especially first home buyers. The person who's bought for 200,000, it's now worth 800,000. They don't care if it's gone to 400,000. They don't. In the end, yes, it's not great, but it's the person who bought at 800 and now it's gone down to 600. They're the ones who are going to, and they're the ones that are kind of, unfortunately didn't get all the benefits of, say, baby boomers and all, but they're the ones who are going to basically deal with the fallout of this kind of unwinding, I guess.
And then my last question, Chris, is if there was one message that you'd want to deliver to, the DFA viewers about property in the current environment, what would that be?
It's that you've got to really understand what a quality property is, and that not every property is equal. And you've really got to, when you're buying property, have an extremely long-term view. I'm talking 30, 40 years, and buy something that's scarce, and hold it for a very long time. But you've got to really just go for that real scarce asset that can't be replicated. And if your property, and this is not to say you should go do that now, but that's the property that's gone up the most. It's the property that in the future. And the reason why it's scarce is that people really want to live in it. And because of where, maybe it's a north-facing block, it's 4 or 5 k's from the city, it's on a quiet street, there's got good schools. There's, if you come back in 20 years' time, it'll still have those foundations. And so if you think I'd like to think that the population of Australia is going to keep going up. I think that's it's unknown, but you think about the world's population's rising. The Australian economy needs to keep going. It's natural for the government to look overseas to import people and money, and to prop up our universities, and and you can already see the figures are still rising, even though there's a lot of noise in the media saying slow down population. You look at the figures, we're not slowing down. And so if our population keeps rising over time, and it's more likely to rise in our capital cities than in our farms and our in our rural locations, because we're going to move to more knowledge jobs than agriculture. So you're likely to bet that long-term population is going to keep rising, and you're thinking long-term. And so then what's going to be valuable in the long term is those real scarce assets that families want to live in,
right? Because
there's only so many. So that's kind of what makes good property. And if you've got something that doesn't suit that, or doesn't suit cashed up retirees, really, I'd really stop and question whether you should be owning that asset. And if you are going to invest, only buy absolute quality. Never fall for the the positive cash flow. Buying kind of 10 properties. All these kind of amazing new property generally. Don't fall for all the spruiking. Just buy absolute quality assets and maybe get one. You don't need to get 5 or 6. Yeah,
Chris, that's great advice. Thank you so much.
Pleasure. Thanks, Martin.
Thank you. So there we have some very, very important advice from Chris there. I'm Martin North from Digital Finance Analytics. Thanks for watching. We'll see you next time.